closing entries. We talked about it. We talked about emptying out those accounts, having to have them at zero balance, right? The income summary account's just an account where we dump what? The income, right? You dump your revenue and your expenses. Your net income's in there. What do you do with it? Where do you want your income to go? To your capital account, right? So that's where we use that account just at the end when we're closing, and we dump those accounts in it. Those temporary accounts are dumped into that, so it comes up with the net income, and then we use it then to transfer the net income into your owner's equity. See, income summary is just an account used just for closing, and it's a temporary account. All right, which is dumped out also. It's dumped in. You take whatever's in there, and that goes into your owner's equity, right? Okay, it's classified as an owner's equity, so it doesn't have a normal balance. But when we finish closing it, because it's step 3, it's going to have a zero balance. So what do we do first? We transfer revenue into the income summary, and that emptied out the revenue account. Then the expense account. Then we take the income summary, because now it contains our net income, and that's where we can put it into the capital account. And then the drawing account has to be dumped, because you've got to have all those temporary accounts ready for new accounting period.
So what is put into the accounting or income summary is zero out.
You zero it out at step 3, right? Here's our fees income. You get all this information right on your worksheet, income statement column. We're taking our fees income, which has a balance $47,000. We're going to debit it so that it has now zero balance, and put the revenue in the income summary account. Then we do the same thing, right? Closing entries, debit fees income, credit income summary. Do the same thing. We look at our worksheet, and we look and see that we had a total of $13,333 in our expenses. We had already added it up. So that's what's going to be debited to the income summary account, and you're going to credit each one of those accounts so that you can zero them out, right? Okay. There they are. Our income summary is sitting there with the revenue in it. There's all these accounts that need to be zero. So we've already got the total on our worksheet, so we can debit the income summary to the total of all those and credit each one. And then it closes out or empties out all of your expense accounts, right? So now in the income summary, we have the revenue and the expenses. So we know what our net income is. We can look right back on our worksheet.
You're freezing up over here.
Uh-oh. Oh, I know I sure am. Oh, crap. Okay, let's see what. Can you still hear me though? No. Is it just the picture? Okay. Can y'all hear me at Mountain View?
Huh? You're freezing up on us.
Okay. Is it working now?
No. Yeah.
I'm seeing myself in the back. Okay. Oh, okay. All right. So, income summary. Step 2, closing. We close the expenses into the income summary. You just got to zero out all your. That was step 2. You just got to memorize this. Step 1, 2, step 3. We're now looking at what's in the income summary. We know it's the net income. We know the net income's got to go to the owner's capital. So step 3 is to put the income in the capital account. Take it out of your income summary. That's step 3. So we close it to capital account, and now our income summary account is at 0. And that's what we wanted to do, because we want all of our accounts correct at the end before we close. Want yours? Here, give Johnny these. Anybody else want to see theirs? Amber, you want to see these?
I love
Mine we'll get yours.
Just make sure.
That's Amber, you want yours? Okay, so here we go. Closed net income to the capital account. Income summary. We've got a balance of a credit balance, so to close it, we have to debit it, right? Debit it. And credit the capital account, which means we had an increase in capital because it was net income. So whatever ends up in this account now should be what we got on our statement of owner's equity.
Put your net income
With that.
under income summary, right?
It's going to be an income summary account.
Yeah, that's
Yeah, because you just took your revenue and put it in there, and you took your expenses.
which makes your net income will be in your income summary.
Yes.
Okay.
So that's where the balance is, and that's the reason we use this. So we can, our next entry is going to be to take the net income and put it in the capital account. Okay. Alright, so now the income summary is dumped, empty. And the last thing we close is drawing account, because it is also a temporary account that must be zeroed out in order, I'm frozen up again over there, in order to start it brand new for the next year, the next period, whatever period of time we're doing. Okay. Drawing account has to be reduced to zero. And we take it out of owner's capital because that's what he did. He was drawing out his capital. Remember, we did that on the statement of owner's equity so that it showed that it reduced his capital. Income increased it, drawing reduced it. Right? Okay. So now, when we've done all these entries, right, now our owner's equity account will show the correct balance that we figured on the statement of owner's equity. Because we added the net income, we took out the drawing, so now our ledger accounts are up to date. Now they have the correct balance, so we can start a new accounting period. Okay. All right. So here's our entries. Closing entries. I know we had close the revenue account first. Right? Second, we close the expense account. Third, we close the income summary. And lastly, we close the drawing account. Okay. Posting, when we go to our our journal and enter our closing entries, we enter the word closing and then list them. List our 4 closing entries. All right. Go through our steps of closing and posting. All right. And then at that time, we're done. We're done with that accounting period. We've emptied out all the temporary accounts, got them into the right place where they need to go, and we're ready to start a new accounting period. Now, as we go on, the next thing you do in this chapter, is here's our cycle, which we have completed now, except for preparing the post-closing trial balance, which is just another trial balance. And what that trial balance shows you is that everything's been done and that all your temporary accounts are closed, and you should only have open just the accounts that have a balance. And the only accounts that should have a balance after you've closed are your permanent accounts, which are your assets, liabilities, and owner's equity. And we're ready to start a new accounting period. So you do your post-closing trial balance just to be sure you're ready to start the next period with correct numbers.
This is what you use.
And that's what you use. You just do a post-closing, which is just another, go back to your ledger accounts, look and see what the balances are, and at that point you can be sure that your temporary accounts are closed, right? Because they should have 0 balances and they would not need to be included in your post-closing trial balance. All right. So there you go. That was it. Post-closing. If you get it right, if your post-closing, balances, and you've shown that you've got all those 0 balances, you should be okay. All deal. All right. Does not contain a balance, then trial balance. Doesn't balance, you got to go back and find it if you have errors. But it should balance.
Is there any way I can get a copy of mine? Like just a version?
I'll give it back to you when you know.
Because this is what I really
Got it right.
Yes, this is what I really like to work on over and over.
Okay.
Because I still get the accounts receivable mixed up every time. But the fees, I got it right.
You got it right.
But with the help of the book.
To go back and be sure. And we use the audit trail to trace the data back through our accounting records. That's where we use our posting references, right? And if you had errors, now if you want to practice some more on this, there's forms available in the. You want blank forms? You want more
Well, I
forms?
really want that so I can do this again.
That you got it right? Okay. Well, I'll give it back to you. Okay, interpreting our financial statements. On this one, all it is looking at to see how would we use these statements. If somebody wanted to know how much, the owner wanted to know how much cash we had, which statement would we tell him to look on? He would hit the statements that, what are our three statements? On your balance sheet. So if he asked us how much cash he had, where's he going to find that? Where's he going to find the amount of cash? No. Owner's equity doesn't show cash, neither does the income statement. Where does your balance in your cash account show up when you're having statements to show to your... Where do you find it? On the balance sheet. The balance sheet is showing all your account balances, right? What about accounts receivable? Where, if he said, how much do people owe us? Where would you tell him to look? Accounts receivable is how much people still owe us, Gary. Right?
Yeah.
So, balance sheet, be where you find that, right? That's going to be your accounts receivable balance. So we can tell them by telling them where to find or which statement to use. How much do people owe, or do we owe other people? Where are we going to find that? On the balance sheet, right?
Just put everything on the balance.
Just about, right? How much do we owe our suppliers? We'd look on the balance sheet, see. That's where our accounts payable are going to be located. Then what? If he says, well, how did we do? How did we do? Did we make money this time? Where is he going to look? He's going to look on the income statement. Right? What's our profit or loss? Okay, so, again, these are the steps that we've gone through so far, through 1 through 6. We go one step at a time, and we've gone through the entire accounting cycle. And I'm not going to go back through the source documents. They flow from starting document all the way through. You know, we can do the general journal first, then the ledgers, accounts are done, then the worksheet and the statements. Okay. So, all right. I'm really proud of you for working on this, and some of you did a very good job, it looks like.
I hope I did.
You took the initiative to go in there and look it up, back through, find it in your book, which everything was there, right? Okay, looks like most of you got it right. You might have messed up on some of your formatting, but if I were you, I would have gone through to see how the formatting needed to be done on each thing, right? Check it again, just to be sure. Be sure you're doing your posting correctly. It's going from one thing to another, right? Posting from your journal to your ledger, and then making sure all your steps are in there and your posting references are correct.
On your worksheet, at the end of the total, if you put total, I mean, do you need to put net income every time?
Oh, sure. Well, this is part of your worksheet. You got to put your totals. You got to put your net income.
I just put total.
We got to know what it is. anytime you have a statement or any kind of a accounting document, you must identify everything on it, like, especially your title must be correct, the date of time covered must be correct, everything must be labeled correctly so that we know what it is, what's on a certain line, right, net income, yeah. Okay. All right. Okay, so does everybody feel like we covered the closing entries in class, and I presented them, and we did them some. Okay, so let's see. We did that little exercise in class. So then we did our practice. The practice that was a challenge, and that's what it was meant to be.
Oh my gosh, it was a
It
challenge.
was meant to be a challenge. It was meant to have you go back and find out everything from day one, or from start chapter 4 actually, about your journal entries first, and then putting in your posting to your ledger accounts, and then taking your information to your worksheet.
Well, we pretty much did start from chapter 1 because you had to.
I enjoyed it.
Yep, it should have been a good experience for you. This little exercise should, if you're starting a business on your own, this is what you'd have to do. This would be what you would do for your business. Well, actually, yeah, right.
Like, you kind of get messed up when you're putting all these.
We're going into different, right. If you're starting your own business, you would first set up your chart of accounts and set up your ledgers, just like you did. They already had your chart of accounts set up for you. You just enter your ledger names and numbers. Then you would start your business and your transactions would take place. It would have taken you 30 days to do this, right? One entry a day or two, whatever. As you're going through and having your entries come in, you're putting them in your journal, you're posting them to your ledgers. So once you get it set up, you would just go into business and start doing your entries, daily entries. And then, at the end of the month, then you would do your worksheet. Take the sheet balance, do your worksheet, complete it, post your adjusting and closing entries, do your statements. Okay, so that would be what you would do for a business. This is really a very simple exercise to really, is what you would do if you started your own little business. You get you some sheets, right, ledger sheets, and make your own or whatever, and set it up and get started. All right, so let's see. We're going to go ahead and out of this, get back over here. I'm going to get you started on chapter 7, simply because chapter 7 is, we're kind of starting over at the same point again. We're just starting at, instead of chapter 4 being using one journal, it's going to be the same principle. We're not introducing anything new. Still do your entries the same, debits and credits. Everything's done the same. The difference is we're going to be using what we call special journals. So instead of one journal where you write your entries, you'll have a journal where you can summarize certain types of entries, which makes it much easier when you're doing your posting and when you're doing keeping up with your records. Because in different kinds of businesses where the businesses are bigger, the businesses we've been talking about have been small service type businesses. Now we're going to look at businesses now that are merchandising. You know what that means? That means they're selling products instead of services like we've been doing. They've got products. So let's see. Go back and open that file. Whoops. Okay. Right. Okay. Chapter 7. Merchandising sales. So we're going to talk about companies that sell goods. posting procedures. We post from journals to ledgers, just like we have always done. We have a little bit of different slant. We have a few little extra things that are included in here, but basically, the foundation in 1 through 6 is what you're going to continue to use. Those are your procedures. That's your foundation. All right, so we're starting with looking at a new kind of store. It's called a sporting goods store. Max Ferrero is a sole proprietor still. We're still working with sole proprietors. But he's got a merchandising business instead of a service business. So he's selling things. It's a retail business, meaning he sells to the general public, to the people that are actually going to be using the product. We've got, and this is an introduction to the kinds of journals we're going to learn to use. We have a journal called the Sales Journal. In the Sales Journal, we record only thing that gets put in the Sales Journal is if you have a sale of merchandise on credit, meaning, what does that mean?
That means they haven't paid us yet.
It means they have not paid us, so that means we create a accounts receivable because they didn't pay cash. So anything that comes in, any purchase, anybody that buys from us on credit goes in the Sales Journal.